Hi, welcome back. In the last session, we talked about investor performance and we came to some depressing conclusions. We looked at how the average individual investor does relative to the market, and we also looked at how the average mutual fund performs relative to the market. And on both counts, we found underperformance. Basically, individual investors on average underperform market indices, and so do mutual funds. And breaking mutual funds into different subgroups doesn't change that conclusion. If you present mutual fund managers with that result, that the average mutual fund is lower than what you'd have made investing in the index, the counter they always will give you is that this is because you have some really poor money managers. And their argument, the counter argument they will provide, is that if you focus on good mutual fund managers, and of course they count themselves among the good managers, those good managers probably beat the market by large amounts. The evidence, though, suggests otherwise. Here's a simple way of seeing if it's the same bad managers dragging the averages down. You can look at what are called transition probabilities. And in other words, here's what you do. You take mutual fund managers, you rank them into four quartiles based upon performance. So from top 25% to bottom 25% into four groups. Then you look at their rankings in the next time period. If there is absolute continuity, in other words, the best managers stay the best managers, the worst managers stay the worst managers, the middle managers stay the middle managers, here's what you should see. You should see 100% across this diagonal. In other words, 100% of the managers in the first group should stay in the first group in the next period, and 100% in group 2 should stay in group 2. And 100% in group 4 should stay in group 4. This is from a fairly old study. And what you discover is actual randomness, absolute randomness. And here's why. If you look at the 100, let's say 100 managers who made the top quartile, and you track them in the next time period, they break down into four quartiles almost uniformly. In other words, a manager has just as much chance of being in the fourth group, assuming he was top ranked this period, as being in the first group. So looking at these probabilities, you cannot rule out the hypothesis that what you see as rankings is completely random. And you're saying this is an old study, maybe things have changed. Here's an updated study. It doesn't look that much different. The only difference in this study is it does add a fifth column, which is some funds don't make it. And in fact, you find that a larger percentage of the worst performers don't make it. So that's a survivor bias we talked about. And you can see less of the funds that perform well get merged or liquidated, and more of the bad performing funds get liquidated. But even looking at the funds that survive, you see that the chances of continuity are fairly low. I mean, there are a few subsets here where you can say, hey, that looks a little, the 27%, which is the high number, looks like continuity, but with quartile, but that's not significant enough to build a story around. So the argument is top-ranked money managers stay top-ranked and bottom-ranked money managers stay bottom-ranked, and that explains the results. The answer, unfortunately, is not backed up by the numbers. Now, of course, there are, especially in the last 20 years or so, there have been attempts to rank mutual funds. If you're an individual investor and you want to find out how good a mutual fund is, in addition to looking at their ads and looking at their past returns, you can go to a source like Morningstar, which provides rankings for mutual funds from high rankings to low rankings. And in fact, there's been an open debate about whether these Morningstar rankings are predictive. They reflect the past performance of the fund, but are they predictive of future performance? Some of the earlier studies were not that favorable. In fact, this study, looking at Morningstar ratings from 94 through 97, classified funds from highest to lowest based on the Morningstar rating and looked at the returns in the following period. And it found that the highest rated funds did no better than the fourth rated funds. The very lowest rated funds, perhaps, did worse than the other funds, but not a whole lot of information in the middle groups, from groups 1 through 9. Now, Morningstar, in response to these studies, did revamp its rating system, and it broke funds down into more groups, 48 smaller subgroups, to allow for different risk adjustments. They did adjust their risk measures to capture more fully downside risk, not just the total standard deviation. And it also consolidated funds with multiple share classes, so it wasn't counting them 3 or 4 or 5 different times in the same ranking. And studies that have looked at Morningstar after the revamp suggest that there's more predictive power now, with higher rated funds delivering significantly higher returns than lower rated funds. So ratings seem to have a little more oomph to them than they used to, because Morningstar seems to be bringing in more information. And what it I think is bringing in, and this is also backed up by academic research, is that there is some evidence of what are called hot hands. In other words, at least for short time periods, the chance that winners in the last period will continue to repeat seems to be high. In fact, this study it's a fairly old study, again, goes back to 1971 through 1990, looks at the percentage of winners being mutual funds that beat the market last year, who will repeat this year. So if you look at 1971, 65% of the winners from the previous year repeated as winners. So you want if this number is a high number, it means there's a high repetition. And you can see that across the sample, that the sample average, at least for 71 through 79, was that 65% of winners continued to be winners. That number became a little weaker if you look at 1980 through 90, 52%. But this is evidence, at least loosely, that there's some momentum effect with mutual funds as well. And this is backed up in a different study, a more detailed study that classified mutual funds based upon the size of the fund. The question it was asking is continuity more common with small funds or large funds? And it found across the board, across all size classes, that there was continuity. Whether you're looking at small funds or large funds, that the best performers were more likely to continue to be best performers. So this study actually looked at the returns of the best performers in one period and the returns in the subsequent period. So it looks at the continuity of performance, and in all the size classes you see some continuity continue in the performance. That's a phenomenon that actually runs counter to what I presented at the very start of this paper, which is about transition probabilities. But at least over short time periods, good mutual funds stay good, bad mutual funds stay bad. And that might explain why Morningstar ratings are at least now carrying a little more information than they used to. But overall, if you look at the evidence, it's not good. The average active money manager doesn't beat the market. And when he beats the market, the likelihood that he will continue to beat the market is not that high, especially if you look at longer time period. And the question then becomes why? Why don't active money managers do better? And I think there are several possible reasons, and I'm going to list 5. The first is transactions costs. I think the minute you bring activity into the game, it comes with transactions costs and trading costs, and especially if you define those costs broadly to include not just the bid-ask spread, but the price impact, it can start eating away at returns. The second is the tax effect, which is the more you trade, the more tax consequences there are. That tax bite can take out of your returns. The third is activity by itself can sometimes be bad. And in fact, there's an argument that can be made that if you're too active, you can hurt your investors. And there's evidence to back that up. The fourth, and this is something we talked about in the context of mutual funds, is often active money managers, even if they tell you they're not market timers, indulge in market timing by coming in and out of stocks based on what they think the market will do. And that starts to hurt them over time as they compare themselves to couch potato funds or people who stay invested in stocks all the time. And finally, there are behavioral factors. The same behavioral factors that affect individual investors show up with active money managers as well. So let's take these issues. Let's take transactions costs. This is actually a distribution of total transactions costs, total annual expenses for U.S. mutual funds in 2011. The median is about 1.5, between 1.5 and 2%. And guess what? The average mutual fund underperforms the market by roughly 1.5 to 2%. So that's not coincidence. Whatever you see going into the process often ends up eating away. So it's not even a question of making additional returns that they eat away. The annual expenses that you see at mutual funds are a burden that is difficult for these mutual funds to overcome. So there's high transactions costs, and the more you turn over, the more you trade, the higher those costs are going to be. In fact, if you look at excess returns by mutual fund class, classifying mutual funds from lowest turnover to highest turnover, the higher your turnover, the more you trade, the worse your excess returns turn out to be. So it's common sense, but it's worth emphasizing that mutual funds that trade a lot are going to have a much more difficult time delivering positive excess returns, and this graph brings that home. And if you look at trading costs, the result is even more direct. It's not just the total trade. If you have high trading costs, you essentially, and this is actually a graph that looks at mutual funds classified from lowest trading cost to highest trading cost. the mutual funds with the highest trading costs end up with the most negative excess return. So if you have an investment strategy that has high trading costs, why? Because you trade in small market cap companies, less liquid companies, you're going to see it's going to become more difficult for you to beat those expected returns, those raw returns, because those costs eat away. Remember in the last session we talked about emerging market funds and how they underperformed indices? Well, this might be the reason. Emerging markets might offer more inefficiencies for you to exploit, but they also have far more in trading costs, and those eat away your returns. The second issue is tax burdens. If you look at the difference between pre-tax and after-tax returns for mutual funds, and you compare what happens at active mutual funds versus index funds, the difference is pretty stark. So if to the left you see the typical average mutual fund and the typical index fund have returns that are pretty close. In fact, the average actively managed mutual fund, these are the 10 largest active funds, deliver slightly higher returns than an index fund on a pre-tax basis. But on an after-tax basis, the index funds are the winners because the tax effect is far greater because of the activity. So the tax burdens can come back to hurt you if you're an investor in an active mutual fund. The third is there is too much activity. In fact, in one of the more interesting studies I've ever seen, a study actually looked at the returns on mutual funds, the actual returns, and compared them to the returns that these mutual funds would have made if you'd frozen their portfolios at whatever they were holding at the start of the year. In other words, if you just sent all those analysts and all portfolio managers home and left your portfolio frozen, what would have happened? So in a sense, they were measuring the effect of activity. And what this study and other studies like it have found that when you compare the returns, the frozen portfolio actually beats the actual returns by 30 basis points, 50 basis points. So all that activity results in lower returns rather than higher returns. So there's too much activity, which also translates into higher transactions costs and higher tax effects. But that's worth noting, is there's too much activity. There's also the failure to stay fully involved. So if you look at the S&P 500 versus active funds, and you break them down by period, and these are looking at bear markets alone, you see, looking across the bear markets, that even though mutual funds claim that that they save money in bear markets, that whatever you gain by losing less money in some markets, you kind of lose in the larger periods. In fact, across all active funds, even though these funds hold cash, it's amazing, they actually do worse than the S&P 500 even in down markets. So if active funds claim that they're holding back cash because it protects you on the downside, there's little evidence of that when you look at the actual returns, because looking at the downside, it doesn't look like the typical average active fund does much better than the S&P 500 in a down market. The way to think about this graph is if active mutual funds were actually really good market timers, you should expect to see zero returns during down markets on the average active fund because they'll be 100% in cash. It's a testimonial again to what happens when you're not a market timer and you try to do market timing. And finally, there are behavioral factors that I think affect mutual funds. The first is a lack of consistency. A study, for instance, that looked at several thousand mutual funds from 91 to 2000 and looked at the styles they adopted, found that there was relatively little consistency. A fund that started off as a value fund would often switch to a growth fund 2 years later, switch to a momentum fund 4 years later, and what would drive that would be whatever they migrated to whichever style had made the most money in the most recent time period. That lack of consistency, in addition to driving down the returns over long periods, also results in higher expense ratios, more trading, more transactions costs, all the things you're trying to avoid when you run a fund. Second is there's a lot of herd behavior. If you look at where mutual funds are investing, they're often investing where everybody else is investing. Some of that is driven by risk aversion. If you're going to make a mistake, it's always nice to have lots of company. So not surprisingly, mutual funds all move into the same stocks and move out of the same stocks at roughly the same time periods, which might allow you to survive as a mutual fund manager, but it's not a great way to make money. Finally, it's well known that mutual fund managers try to window dress their portfolios. Towards the end of every quarter, every year, they sell the stocks that have been losers over the year and try to buy the stocks that have been winners. It's too late for you to make money on the winners, but you want it to look like you had the winners all through the year. That window dressing costs you money, both in terms of selling stocks you otherwise wouldn't have sold, but also in terms of taxes and transactions costs. So all those forces kick in, and if you add on top of that the incentive system we've set up for how mutual fund managers get rewarded. We don't reward them for being good mutual fund managers. We reward them for being followers, for essentially doing what everybody else is doing. So if you look at the last two sessions, this is basically what our conclusion looked like. On paper, it looks like there are lots of ways to make money. There are dozens and dozens of market-beating strategies on paper. And you can point to any one of them and say, hey, look, that's an evidence of market inefficiency. But when you look at the people who try to take these inefficiencies on paper and try to make money on them, then markets magically become more efficient. The average active money manager, even though he has access to all of these different ways of making money, doesn't seem to be able to deliver those excess returns. And that might be because of the transactions cost, the difficulties in trading, other frictions. But whatever the reason, the performance of active money managers is the best sales pitch you can make for not being an active money manager. And that's a pretty depressing way to end this particular session. But on that note, thank you very much for listening.